take any trades unless you see this signal forms on your chart. The signal that I'm talking about here is called the first pullback, and in this video, I'll explain how you can use it to minimize losses while increase profits for every trade that you take. So without further ado, let's get into it. So, what is the first pullback? The first pullback is a highly predictable pattern that shows up in almost every trade setup. Here's how it works. Imagine the price is in a downtrend and begins to reverse into an uptrend. As we know, it's extremely rare to see a perfect V-shaped reversal when the trend is changing. What typically happens is the price starts to reverse, makes a brief pullback first, and then continues climbing. Now, this initial pullback after the reversal is what we call the first pullback. And I'm not exaggerating when I say this pattern is everywhere on the chart. Want proof? Let's look at a couple of examples. Take a look at this Bitcoin 4-hour chart. The price was in a downtrend and reversed upwards. It then made a slight pullback first, before continuing trending higher. Here's another chart from gold, or XAU. This time, the price was initially in an uptrend. Then it began to reverse downwards, but it made a slight pullback first, before continuing downwards. Here's a chart from Apple stock. The price started off trending downwards. It then reversed upwards, made a pullback, and resumed upwards. You can find countless of examples like these on any chart. Try it out for yourself after watching this video. So, the main concept behind this strategy is to time the first pullback and aim to enter at around the end of the pullback. The key reason for this comes down to one crucial factor: risk to reward ratio. Let's break it down with an example. Imagine spotting a setup where the price was initially in a downtrend. Then, a strong buying pressure pushes it upwards. As a trend trader, you might see that the trend begins to shift and think about entering buy. But buying immediately at the highs of the trend isn't the best move. Why? Because there's a chance that the price could pull back. Or worse, the uptrend could fail entirely. If you enter at the highs with a tight stop loss, the pullback alone could stop you out. And if you set a wider stop loss to account for the pullback, you'll end up with a much bigger loss if the trend fails altogether. This is exactly why waiting and entering at the first pullback is almost always the better play. At a pullback, you're getting in the trade at a more favorable price, which means your stop loss can be tighter. If the price keeps dropping after the pullback, that's a signal that the uptrend is invalid anyways, so having a tight stop loss keeps your losses small. But if the trend holds and price pushes higher, you're set to make bigger profits since you've entered in at a lower price. It's a win-win condition. You'll get smaller losses on failed trades and much higher gains on successful ones.